So happy Tuesday. Thank you guys for being here at Psychology Lab at BluSky. My name is Coach Becky. I am very happy to be here with you. And we talk all about trading, right? At BluSky, because futures trading, right? That's our jam, all things trading. Well, a key component to all of that, right, has to be risk management, stop loss management. What do you do with that? How do you manage that? How does that work for you? Or do you always honor it? If you don't always honor it, what's your issue with that? Where are the pitfalls in your system? How can we shore that up? And then also, like, what do I personally do as a futures day trader? So that is what we're going to talk about today. I want to get into the logistics of stop loss, but I think we have a robust coaching team at BluSky, which Matt and Riz and Breezy, Blasky and Justin. So I think that we have talked a lot about it. So I'm going to lead in with the psychology of it. And then the second half is going to be getting into a little bit more logistical on how I do my stop loss management when I trade futures. But I think that there is an art to risk management, and it absolutely pokes at all of our psychology. That's just fact. So let me elaborate. How about? Thank you everyone for being here today. So what we are going to talk about today would be, I think, like I said, two parts. So I do think that stop losses are not as pleasant to get hit, right? Especially when you're a new trader. Taking that hit to your account is a sting, right? To say the least. I think a small stop loss hit is a little bit of a sting. There is no one who doesn't feel it. The difference is what happens to you when it gets hit. And so that is a big part of our psychology and when we start trading, you're going to have an experience with it. And then how you adjust that as you grow as a trader is a big deal. And it's something to pay attention to. So I think learning to accept stop losses is what makes you a professional trader, right? Accepting a stop loss doesn't mean that you're weak and that you're a trader who's not making it. It means that you are a professional trader and that in the game of risk, not everything's going to hit. And so then we'll get into the actual part on the second half of today. But basically, there's a multiple different things that play into risk management as a trader and what happens to you when you are in a situation where your trade is going to have to close red. But we want to always remember about probabilities, right? Trading is a game of odds, not certainty. And so that needs to be a part of the reframe on how you take this whole conversation in. That stop losses are one key component to the game that you are in as a trader, right? And then also, what can we do to accept our stops more peacefully, more openly, to just let that be a situation that happens? Let go of it. Don't let our ego be played up into it. Don't let our emotions get triggered to the best of our ability, because once you're triggered, that tilt spiral is super dangerous, right? It's a very real thing. And then the core to this whole conversation, let's be real, is capital preservation. We have to have capital to be traders. You have to have funding. You have to have an account in order to execute a trade. Real talk. So let's just get into all of the things today. So probabilities, right? Trading is a game of probabilities, not prediction. I think we all get into trouble when we try to predict the market. I think you need to make a shift from I want to be right to ideally I want to be consistent as a trader. Every single trade that we take is kind of a data point in a long series of outcomes, right? You have a trading strategy, you have a playbook, what trades you like, what is a good setup for you, and then how often it succeeds, how often it doesn't work out. There's a playbook situation in that. Nothing's going to be perfect, though. With that, there is a modicum of failure rate, right? No market condition is always going to give you your desired outcomes. Exactly. Consistency is the goal. And so to have a strong system, it does not mean that you're going to win every time. It means that you're going to have to take some hits. And so internalizing that and making that a part of our process is a key to actually breaking through a lot of barriers in trading. I think being able to accept failure is how you actually ultimately make money, which sounds counterintuitive. But I'm going to kind of talk around that a little bit today, but there's some numbers behind it. There's some science behind it, but being able to be stopped out is, I know it feels like, what? That means I'm ending red. It means that you are treating it as a business and you are allowing it to close if the trade is not working out as intended. So look at this. So a lot of traders, even the most successful, big name traders and funding companies, will have a 60% win rate. That can be profitable. That means that those traders they can manage millions. They can be big hedge fund money makers, money movers. But in that situation, 60% win rate, you guys, they lose 4 out of every 10 trades. 4 out of 10 trades. And so if you're even trading with big size, like 4 stop outs, like that's a money being deducted from your account. But in that scenario, in that trade plan with that system, that's a winning system. That is profitable. So if you can like really open your mind to like try and let this conversation sink into your subconscious, we've got to be able to make sure that a stop loss is not viewed as a bad thing, because it can be absolutely a part of a winning system. The stop losses, when they are hit, it's data, it's information. And when you say you have a 60% win rate on the 4 that get stopped out, there's room for improvement there, right? And so taking that as data, the wins and the losses get to help you, they provide information. They say, in this situation on this day, this trade resulted in a loss. Why? What happened? What was different? Was there a little tell that was different? Was there a data point that you missed? Was there a larger time frame you forgot to check? How can you sort out your edge, and how can you make it stronger based on what the market is telling you? And so I think in that whole context, we've got to pull the outcome out of the value necessarily, because a trade ending red doesn't necessarily mean it's a bad trade or a poor quality trade, right? Outcome is not an equal relation to quality necessarily, if you're adhering to a system that you have defined and studied and researched and like established. So a good trade can lose basically, right? And a bad trade can win. We've all been there, right? You just like throwing some contracts around willy-nilly, not even paying attention or not sure if it's even within your system, and it wins. That's not like a super celebratory situation, because it's not part of a robust system necessarily. But if you have a really good trade and it's stopped out, that's just a data point in your system. And you need to kind of help continue building a strong process is the core behind all of this, not necessarily just striving for green. Because if you're always hunting the green, generally in that situation, your P&L will struggle for that in the long run. Let me explain. So why do we fight the stop, right? I don't know exactly where everyone who's in the lab today is at with this. I think that this is hard in the beginning, and ideally will improve the deeper, the more years that you get into trading. But we have to quiet the ego. You have to have some element of ego in order to be a trader, because you have to have some energy behind putting that risk on the line. That's just nature of the beast. But you have to control that ego, keep it in its place, let it be contained. So when you're trading, right, price approaches your stop, something does fire in your brain. The amygdala is the emotional response to our system, right? As the fight or flight, it's the sympathetic nervous system. It registers a threat. It means that this money-making plan that I had is taking money from me. And so right away, your body can start to fire in those neurological pathways of aggression, fear, wanting to fight the market. But psychologically, it's threatening your identity, your ego, your confidence, your ability to feel strong and good as a trader, as well as your P&L and your account. And so being stopped out can feel like you are wrong, you're inadequate, you're unworthy, you somehow missed something, you're not a good trader. But that is a real problem, because that can lead to emotional choices. That can lead you to manage your trade emotionally and have destructive decisions, right? Where you can average down, you can pull your stop, you can hold a loser past reason, and really get yourself into trouble if you go down that pathway of like, I am being threatened by this market and this trade was supposed to win and now it's going to lose. So shit, what am I going to do? That is such a dangerous path, but that is the ego, right? It makes a losing trade mean potentially, I can't do this. Like, I'm never going to be a good trader, blah, blah, blah. Right? The things that we can tell ourselves in the moment, when it starts to threaten you, the brain goes into like rapid fire deal with this mode. That is the sympathetic, like you're going to like punch somebody in the face that's coming at you because you're defending yourself. Well, trying to punch the market back in the face by pulling your stop so you can be right is dangerous, because it's not a sustainable system. It's not a part of a successful strategy that works long term. So we've got to break that link, basically. That's what the heart of my conversation today is going to be about, is we have to break that link between taking a stop as being something that is hurting you, that is a threat that you need to fight against, versus it is actually just a part of a professional trading business. Your trades, each individual trade does not define you as a trader, but more so the system that you consistently execute does. And so if we can shift that mindset into more of an ownership of the system and the way that you respect it and the way that you execute it, so much more powerful. So like the ego trap, right? So you widen it just this one time. Like, I know I did it last week and I was never going to do it again, but this time I'm going to do it one more time because I really think this trade is going to work. Or the trade is working and you just came out of a stop, and so you move your stop to break even out of fear, and then it takes you out. Right, this time is different. This time it's going to work. I'm going to just add one more contract because now it's going to hold at this level. I'll just scooch my stop a little bit, add in one more contract because I really like, this is a good trade. I am a good trader. This is going to work. Today was going to end green. It's going to be fine. Just give it a little bit more time. All of these things are the things that we tell ourselves in that moment when we don't want to honor the stop. That's what it is, right? We don't want to take the hit. No. So I'm telling you, these are the things that we tell ourselves. It's a hopium. Don't huff the hopium is basically what's going on. But our body wants to. It's a natural inclination of fixing it before the outcome is finalized. Once the stop is hit, your account P&L changes. Your threshold for the day changes. It is locked in. It is a done deal, right? And so there's a moment where our ego fights to not let it be locked in, but you have to make a choice, right? So respecting the stop is an act of professional discipline, not defeat. And I think it can feel like defeat in the moment if we are letting our body get rolled down that sympathetic amygdala firing emotional response. It will feel like a defeat, but it is not. So we have to decide that we are professionals, and a stop loss is an outcome that happens within a winning system. And I think that I don't know if you guys are like me and you like sometimes binge watch journey interviews of more advanced traders than myself, but I like to watch those videos and I like to hear about how they worked through the hard points and really dialed in. And almost always it is when they realized they had to keep their losses small and allow their winners to like sometimes be like killer trades. And that respecting the risk and the stops is like a huge pivot point for nearly all traders that you will hear of that are successful down the line, such as Ed Sakota. The elements of good trading are cutting losses, number one, cutting losses, number two, cutting losses, number three. Like, that is how you are a good trader, because you don't let those, right? You don't let those losses get outsized. You want your winners to get outsized when they're really rolling. You want to have a good system of managing your risk and like, adjusting your stop loss up, but your losses aren't the ones that get out of control, right? That is a sign of a professional trader, which is where we're all aiming to be, right? Everyone is on their own journey with that. Everyone is at a different place with that. You could be 3 months into your trading year, 3 years, 20 years, but this is all a conversation that we all have to, be mindful of and be on our own journey on and master if you're going to stay in this. Yeah, 3 years is a tricky point because you clearly have a strong edge and you know how to make money, or you would not have made it to 3 years. But then those old habits that were initially probably really hard are going to be still a factor of you're trying to maintain the healthy choices and not the poor choices, because it really does take a long time for your habits to truly subconsciously shift in the choices that we make. And I think that is something that happens in years, 1 through 5, ideally. And if you make it past that, you make it past break-even outcomes, you can really start to lock into some consistency with that. I think there's a sweet spot there that happens. Now, I love thinking about trading as a business. I think that that's a really powerful analogy for me. And a business owner budgets for operational expenses, right? You need to pay your bills. You need to buy your product. You need to pay your insurance on your thing. You need to pay your employees. There's all manner of businesses and all manner of expenses within those. But if we equate trading to that, there's a cost of doing business as a trader. It is pre-agreed upon. It is a rational choice that you make when you are calm, clear-headed, and aligned with your system, and you recognize that there is a cost of being a trader. Like, it's not a free sport. No one gives you money, or you don't have money that just is wide open and never at risk. there's always a cost to being in this business. And you don't want to think about that in the heat of the trade. Instead, you want to recognize this and outline it as your business strategy before you're trading. Look at that. That's a beautiful equity curve. So reframing this is a really good way to drop the emotional charge of what a stop loss means, because there are expenses being a trader, right? Sometimes you pay for a mentor early in your career when you're learning your edge and establishing it. That's an unreasonable expense to this business. You pay for your account if you're trading with prop funding companies. You pay for your stop losses when they're hit, because those are the losses within your system that it is accounted for. If you have a 60% win rate, 40% is going to go against your account. That is the cost of operating the business. That is a 60% winning strategy that is overall successful because of you managing and you accepting those losses. So these are the costs of doing the business. Now, there's different along the bottom here, there's slightly different variations on this, but the business budget is every trade has a predefined maximum cost, your stop distance. You choose it, you approve it, and you honor it. And so just saying, on this trade, based on where I need to put my stop, we'll talk about specific strategies shortly about that. But if you say, based on this trade, if I get this entry and this is my target, this is where I'm basing my stop loss off, this is a $350 risk trade. Approved, that is decided on. You enter the trade, either it will hit or it will hit your target. But that is the maximum loss on that. That's a business budget idea around a stop loss. Which also expected value model with positive expected value requires a loss to function. So refusing stops kind of corrupts that model, to be honest with you. You can't say I have a 60% win rate, 40% loss with this risk to reward. It is consistently profitable. You won't have statistics if you monkey with it, right? You can't. Your journal is not going to be nearly as functional for you if you don't honor your stops, because you're not even going to have data to have it. It does destroy that edge because you can't even say this specific strategy has a specific set win rate. If you are monkeying with your stop all the time, if you are prolonging it, if you are adjusting it to win more of the time by taking a deeper stop, but then sometimes your accounts gets destroyed because that went very wrong. You're not even going to really know how to have an expected value of your trading system if you do that. So I would urge you guys, as you are establishing your trade plan, to really try to at least have periods of weeks to months where you strictly honor a system. That way you can get real data to base your understanding of your edge off of. And you can even figure out if a trade setup has a positive expected value when you have real data. But you won't have real data if you're constantly adjusting your stop, because it will corrupt essentially that model. It will make it gray and muddy, and you'll just kind of be trading, floundering around, not with any sort of consistency in your data and your system too, if you're not able to gather like real information on what you're doing and how you are doing it. Also, I love this pre-trade contract. So your stop is a contract you make with yourself before the emotion entered the room. When you're not in a trade, you just are less emotional. And unless you are a robot or you're, a longtime veteran of trading, then it doesn't hit you the same way anymore. When you are not in a trade, you feel differently about the risk. When you are in a trade, it feels stronger. And so your job is to honor it. So if you can do some sort of coach yourself and have a pre-trade contract essentially with yourself of, when I take this trade, my risk is going to be $350. It just has to be that. I don't want to add another contract and then get a worse fill on that and then have it be in for double and have it be an $800 risk. That's not a reasonable choice for me right now with this account size, with this account condition of my trades. And so then I don't get to add size to this based on what I am trading, the risk that's already in there. Ricky, I'm glad you're here. Thanks for that. And please, you guys, if I am going too fast or you have any questions on anything, throw them in the comments, because I absolutely love this conversation too. It shores me up as a trader, and it's valuable in my opinion as well. So I'd love that pre-trade contract, because you're not emotional yet when you haven't entered the trade. And so try to just really recognize eyes wide open kind of energy, because it will be harder once you're in a trade. Your emotions just ramp up. That's the fact. Okay, so how can we build stops into our probabilistic outcomes, right? So a well-designed trading plan doesn't just account for wins, but it explicitly budgets for losses. Do you guys ever think about that? I know we all like to say, if I enter at a value area high and I want to take a short back into the point of control, say it market moved up and it's showing signs of reversal and you want to get in, you think about the win, right? Initially, our brains, especially when you're young, in trading, you think about the target getting hit, right? How much can I make? How long can I push this sometimes too? But you do want to explicitly think about your budget for the loss on that trade. And that is a reframe that takes it from a little bit more of a gambling to a business strategy. And so in that picture, it's not necessarily what one stop would be, but more so how many consecutive stops can my account hit before it's in drawdown, before it blows, before I hit my max daily loss. If you want to be able to have maybe 3 trades in a day, well, if you decided that your max daily loss for this account for one day is $600, if you would like to stay solvent so you can take a couple trade opportunities, each trade shouldn't have more than $200. In that situation, no matter what futures instrument you trade, you got to be looking at micros for that, right? Let's just kind of reverse backwards. So you need to think not only per account, but how many trades can I make in a day on that account with this idea, right? How many losing trades per week also? Like what if we're here at BluSky, we trade prop firms. And so then you want to think about maybe in your entire week or the size of the account, depending on what your account size and how much room you have. And so think about too, how much out you can do. Can you withstand 5 trading losses in a row? How can you manage this so that you can stay trading, right? Ideally, we're not doing resets every day because that can get really expensive. And if you're funding your account fees based on maybe your other work, like if you have a day job, air quotes day job that is funding your trading, if you're not quite yet profitable trading, you need to budget that because you can't necessarily just take money from your grocery fund necessarily for like a ton of resets. And so factor this out so that you can trade for a whole month. When you are learning to trade and you're not yet profitable, that's a really important factor to allow yourself the time to learn. And so by scaling down and by respecting your stops, you basically get to give yourself the time to learn the craft that is trading. And that is why we have to have strong risk management, because when you are dialing it in, you need wiggle room to figure out what's wrong and what's right, such as the conversation of what's a mini and what's a micro RQ. So if you haven't answered these questions yet, I would argue that maybe your plan is not super robust. Maybe you're just kind of trying to like throw contracts at the market based on hype, based on energy, based on what you heard last week, based on a good trade that you had that you won. Maybe you didn't fully understand it, but you want to do it again. I get that. But if these are things to think about in your trade plan, and maybe put a line item in your trade plan and how you're going to address this and what you're going to do with it. Vibe trading. Exactly. I feel like we're long today, so I'm going to buy all the things. That's a vibe trade. Yeah. But I do think that there is so much power in journaling and then looking at your numbers, right? And so you can calculate your expected value per trade once you start getting data in your journal by calculating your win rate combined with your average win will give you your expected value on that trading. And so you can kind of dig into your data, like play with it a little bit, see how much certain trades will win, how much they'll risk. Is that like a 2-to-1 type of situation when your trade sets up? And in that situation, what kind of max losses can you tolerate with your size, with your standard risk size? And if you can consider before you really understand all of this, if it does feel gray and it's uncomfortable and you're not really sure, try to trade it smaller size. Try to trade it with where you might consider a mini, maybe do 3 micros. That gives you the scaling ability and it just downsizes it so you can really lock in and you can always scale up. I mean, this market really is abundant and the prop firms give you actually quite a bit of leverage to use at your disposal. So there's the room to scale up. But ideally, you will not pay a ton of reset fees while you're sorting that out and you get ready to scale up because your psychology will be more steady without higher leverage on. And so having your psychology hold steady will allow you to be a trader long-term, right? You're not going to get your mindset totally thrown out the window because you're having these huge roller coaster moves that are really stressing out your body and your nervous system. That's a lot for a human body to take. And it can impact your other life as well. So anyways, I'm going to stay on track. But also a weekly max drawdown limit is a good idea, not just as a suggestion, but as a circuit breaker for your trading, especially if you're like blowing through accounts. At some point, you need to just be like, if you're kind of on a tilt situation where you can't get control of it and you're making poor choices with your risk management, I would argue in that situation, take a break. If you find that it's Wednesday or Thursday and you just cannot get it locked in and get your trajectory turned and you are starting to make emotional choices, take the rest of the week off. Like, let yourself have a reset day, Thursday or Friday, do other work, do a hobby, get out of town, go for a walk. Get a little bit of a time off to allow that nervous system to really settle back into a good base level. And then you can come back at it. I was hunting around about survival rates and stuff, and I love this situation of the account survival rate percentages here at the bottom, where it's just like if you honor every stop and you have a positive expected return system, that's a 94% survival rate. And I don't think that these statistics are like for everyone who buys a prop eval, 94% is not the amount that pass, right? We all know this. So if you skip 1 in 10 stops, it drops rapidly, right? 71%. If you skip 2 out of 10 stops, 48% for your account survival rate. And so that is basically, it goes down drastically because if we don't honor a stop, any number of outcomes can happen. And usually it's at least double the loss of what your stop would be, because if you make the emotional choice to move it, it's usually not a half a tick. It's usually like a whole nother level down. Am I wrong or am I right? You know what I'm saying? And so your account's blowing rate rapidly increases is the moral of the story every time you don't honor your stop. Wow, I know, it's a little buzzkill. We're going to get back into like the positive moves, right? Full port. Oh, Omar, don't tell me about the full port. Okay. This is a little bit wordy of a slide, but basically trusting your system through your drawdowns, right? So drawdowns are not evidence that your system is broken, but they are a statistically expected phase of a trading strategy. And the danger is when you stop trusting your system mid drawdown and start improvising. I get it, right? We are humans. We are smart. Like, to be a trader, you are smart. Like, I mean, not to say that anyone isn't, but it's an intellectual work, right? But improvising is tricky because in a losing streak, it will almost always compound the damage. If you are on a losing streak or really high in overconfidence too, highly emotional states, and you start improvising, it will compound the damage quickly. And so confidence in your system must be built before you enter a drawdown. Through backtesting, journaling, honest performance review, getting your data, real data, and then studying it and building your system more robustly. That way you can trust it. When you are in a drawdown, you can understand what the numbers mean. So build your confidence in calm markets. Review your historical data. Days like today, where there wasn't a great lot of opportunities at the end, take small scalps, and then, or just abstain and maybe do some backtesting that day, or spend some time digging into your journal. That way you can kind of understand your edge a little bit more, fine tune your playbook, build it so you can be a trader and not be executing trades. You can use calmer markets in order to do some of the back end work of it. Define your drawdown tolerance in advance. And so I love this idea of like thinking about stop losses with eyes wide open. So how many losses can you take before you really need to step back and you need to take a break? What will affect your psychology? Is it one, your first stop out and you're starting to feel some kind of way? Or is it like on the second one, you're like, no, now I have to start winning. That can be a situation where at a minimum you do like walk away and take a break from your trading just to reset, you know? And then I think distinguishing system failure from variance. So there's going to be certain market conditions where the market will shift a little bit and your trading system might not just work in that situation. And you need to take in the data and understand what has shifted. Why am I hitting this wall? What do I need to adjust in my system so I can get back on the right side of things? And that could be a market structure shift as a signal. But then knowing when it's like market data driven versus you are not using your system right and you need to change it around. So a lot of different things that take into factor with your system and your trading. But I think there's emotional aspect of accepting the stop losses ahead of time. So what does that look like moment to moment when you are in your trading day? That's what I want to talk about here, is when you are a professional trader and you need to accept a stop. How do you do that? It's not passive, okay? So it's not just you put on the trade, you put a bracket order in, there's a stop loss and there's a target, and you just let it go. I would argue that while that's the dream, that you can just let it play out and let it be. I think that the reality is we are thinking about it. You put on a day trade. It's an active mental process until it becomes automatic. So down the line, when you have more maturity with it, you can be really confident in like, I'm going to place a stop and I'm going to place this target. I'm going to be okay with whatever happens. But I think earlier in your trading career, our minds are on it. Your mind is thinking about, what does this mean? Is it getting close to my stop? Am I watching it on my desktop? Do I put it on my phone when I try to walk away and just let it play? So I think that you want to be able to have a framework and a plan so that you can be less reactive and more just letting it happen and that will help you honor the discipline too. If you're kind of hands off and you're letting it play out and be just a natural flow, once you get in that trade, you're in that trade. You have to have the acceptance that hopefully you did accept before you entered it, that pre-trade acceptance. So let's start with that, right? Pre-trade, set the intent. Define your stop before you enter, write it down even. You can make notes, whether you journal on paper or if you journal in the system, whatever you do, but write down what your stop would be. That can help you make it kind of concrete. When you write something down, it makes it more real, more tangible, more alive. So you write down what your trade would be and commit to it. And this is kind of like a contract that you honor regardless of what happens, right? If this trade goes against me, I lose $400 on my account. That's the situation. That would give me one more trade per my system or no more trades per my system, whatever have you. You accept it at the beginning of your trade without punching your screen. In the trade, when you're in the trade now, you enter the trade, you've accepted it, you observe, but you don't react, right? At least not initially when the trade is starting to move. So the price is going to start to move. In this situation, we're talking about risk today. So it moves towards your stop. Well, your job is to observe. You did not have a plan to add to a loser, to dollar cost average, to widen your stop. You accepted the stop on that particular trade. It was placed based on a reason that we'll talk about and that the other coaches have talked about as well, but you placed your stop based on a reason. And so your job is to just observe if it's coming at you. It's set. You need to breathe and let the market move. And if this trade plan is invalidated by that level not holding that you were leaning on for your trade setup, it's going to get hit. That's, 1 + 2 = 3. After that happens, let's say it does happen, right? Stop loss conversation today. Post trade, you want to review with less judgment, right? To be gentle on yourself. Recognize that this is a game of risk and you're going to take some hits. So try to just review it with eyes wide open and a calm approach emotionally to it. That way you can take the lessons from that. And maybe, your system will improve based on that little review that you have on that trade. And so when that stop is hit, you want to ask yourself, first and foremost, did I follow my plan? Was this a planned trade and did I honor it and respect the stop loss? If yes, great. That makes it a professional trade. You did your job. You treated your trading as a business. Good job. No matter if the trade ended red or green, that's something you just want to note. And if you did not honor your trade plan, whole nother conversation, right? Different lessons to learn from that. But that is ideally the situation is you will have observed your trade and let it hit if the stop was hit, if it was threatened. The point of risk management, no matter how you cook it, is to maintain your accounts. Your capital is your ammunition. It has to be protected. To be a trader, you have to protect your business, right? You are the owner of this trading business that you are doing. And so it is your baby, right? We all protect our babies. We put gates at the top of the stairs and we don't have chokables out when you have a tiny one around. Like, you do things to protect your baby. You have to protect the capital of your accounts as well. Now, I know prop firms have shifted the game, right? It's no longer you have to save up $20,000 from working for a year and then you get a go at learning trading, as was done for the duration of the stock market till the last, 5 to 8 years. Now we have prop funding companies. And so it shifted a little bit. You can reset and get a new account, which bless them, because this is such a resource that has really changed the game and allowed a much lower barrier of entry. So a ton of us can learn trading. But we still need to treat it with respect because the reset fees are hard on your body and they are an account. So you want to think about protecting your capital. Now, I know Matt has talked about this in his lab because I've heard it in other rooms as well, but the math of ruin. And so every loss you take, it does. The reason why you don't want to have them get super outsized is that it's a pain in the butt to repair, to work your way back. It becomes harder and harder the deeper you get in a hole. So, for example, a 25% loss requires a 33% gain to recover, right? So let me break this down if you haven't heard it before. Let's say, just for the ease of our brains, you have $100 and you lose 25%. So you lose $25. Now you have $75. So to get back to where you started, you need a 33% gain because you only have $75 in at that point. So you need to make 1/3 of your purse basically to get back to where you were. So already you have to fight harder with less resources. 50% loss requires 100% gain. Same $100 account you're starting with, you drop it down to $50 based on a big loss, right? For that account size. And so then you need a 100% gain. You need to 100% your capital in order to get back just to where you were, back to that $100, and so on. So the larger the hits you take, the harder you have to earn it back. So keeping them small and reasonable means that you're not doing a big hit that creates a bigger hole faster to have to dig out of, basically. Every time you violate a stop, you are making it more hard for yourself to be able to trade tomorrow, to be able to have the same energy and cushion and account size to be able to place a trade without added psychology. As your account shrinks and your drawdown gets smaller, we've all been there, right? It feels tighter, or it feels like a squeeze on our psychology as much as on our accounts. That's a real experience in that situation. And so if we can do our very best at capital preservation, it's not so much about avoiding losses, but it's more about keeping them small and reasonable so that no single trade can eliminate your ability to even trade. When you have those big outsized losses that takes your account, wipes out 4 days worth of winning in one loss, it triggers you psychologically, and it just makes it harder to get back because you have less cushion. So you're going to trade maybe a little bit more fearfully, which means you might choose to manage your stop a little differently. And if you are kind of monkeying with it, you could, squeeze it, heaven forbid, and then you get death by 1,000 paper cuts, which still amounts to a big loss because you're trading emotionally. And so that's a big psychological element to capital preservation, and why taking the losses reasonable with a reasonable leverage within your account size will preserve your capital big picture, because they help you have that cushion so that you can execute each trade independently and not have as much carryover, essentially. I love this last part here about the traders who last in this business are not the ones who avoid losing trades. They're the ones who never let a losing trade become a catastrophic one. That's the thing, right? We all will take stop outs if we shoot our shot at our best setups and they just sometimes don't work out. If it's within the range of our normal trading day, by the next day, it could just be a memory. You could come into the market fresh and think about what you have, because there's no necessarily heavy limitations on what you can trade, because your side is reasonable and yesterday's impact doesn't have a huge carryover. That's the goal that we all want to get to. So our accounts are safe and stable to trade with a fresh mind every day, which is the psychological element of capital preservation, right? So far we've talked a lot about mindset with stop losses and risk management. That's kind of the way I wanted to start the psychology lab, all around risk management. Was talking about the probability thinking, ego discipline, variance tolerance, and capital preservation, because those are the backbone to this whole conversation, besides just the dollar signs, right? They all are serving the purpose of giving you the psychological foundation to execute your risk management mechanisms flawlessly, to be able to take your trades without trading emotionally. So let's talk a little bit about the statistics of it. Yeah. Oh, I love that. Good job, Gotti. So there is different ways to trade, to have your stop loss management. There are different successful strategies, is what I want to say. That's sort of the energy that I have. Now, I have not been a trader. I've been a trader for 5 years. And so I don't have extensive years with trading different strategies and really dialing in and having one that I feel like for me is a holy grail. More so, I have been exposed to a lot of different stop loss management techniques, and I found the one that works for me with the instruments that I'm currently trading. The psychological foundation that I just covered is applicable to everything in trading. Every style of trading, every instrument that you trade, every trade that you put on, you need to think about all the things that we talked about today. Capital preservation and managing your ego, having some variance with it. But I think for your instrument that you are trading, you do need to have a framework for what your trades, your risk management, your stop loss looks like. So you want to have defined parameters and set rules, and then you size appropriately to that, which is a big part of your risk management. And then something that you can execute consistently, right? Consistent execution on our risk management is key to all of this, because if you have a great system, but you only actually honor it 1/3 of the time, then it's not actually, you don't actually have a system because you're not doing it. That's just, sorry, not sorry. But once you transition to being a professional business trader, it has to be honored all the time to have that consistent repeatability, and give you the long-term outcomes that you would want. So mindset without methodology is wishful thinking. Methodology without mindset collapses under pressure. That's sort of the element of what I bring to this risk management conversation is you want to have the strong risk management, and you also have to have a system, a technical system, right? So let's talk technical. This information is kind of about a 50K account. And so with crowdfunding companies, really you have a $3,000 account with the 50K account because it's about your drawdown size. But you want to risk a small percentage. That way you have trades to execute each day, right? You need to be able to have, 1 to 3 trades at least of wiggle room in a day. And then you want to have multiple days worth before your account is blown. Otherwise, you're just hemorrhaging fees all the time. And so you need to figure out what that looks like for you. If that is like a $300, $400, $500 risk per day, and then your account locks you out. Excuse me. So you want to have a hard daily drawdown limit. And then when that is hit, your trading day ends. And I know that sucks, but having a hard line system that just shuts you down and locks you out is a system for longevity, because that's the capital preservation. It says you haven't quite nailed it yet today. I'm sorry. Thank you. Next. Try and do something else for your day. And then maybe tomorrow you'll be more stable. And the reason why this works is because oftentimes, especially earlier in your trading career, each stop out, either it's 1 or 2, is a person's threshold generally. For your first couple of years of trading, when you hit a loss, 1 or 2 of them will start to trigger you. And so just having your system say, you decided this when you were level-headed, you're done. Better luck next time. Have the day. Respect that and learn to appreciate it. Just be like, you know what, that's the day that we're having. So what can I do with the rest of my day if it happens by 6:45 in the morning for my West Coasters like myself? That sometimes that happens to me, and I'll be like, well, I guess we're just gonna, have a gardening day because there's no more trading or whatever. But determine that is part of your trading system. Now, also, this is a big part of how I manage my risk here, this component. So position size first. And so you want to determine where you're going to put your stop, whether it's based on ATR, whether it's based on the levels that you see and you see a pivot based on, whether it's based on an EMA, which is an indicator system. When you determine where you're going to put your stop at based on a given entry, say you can get an entry at 6,800 and your stop has to be at 6,810. That's a 10-point risk. So can you trade that with a mini? Can you trade that with 2 minis? Probably not. Can you trade that with 5 micros, 3 micros? So figure out first, your trade setup indicates I need to have 10 points on this specific chart that I am looking at, my market. And so if that is the size, the location where my stop needs to be, you need to quickly have a system for calculating how many contracts you can execute in that situation. What can your account tolerate? If it's only a $300 drawdown, and that needs to be the size of where your stop is appropriately placed for that setup, so you won't get wicked out unless the trade is wrong, then you can only trade for 3 micros. And so that's the whole point of a stop loss, right? You guys have heard this before, right? When that stop loss is hit, it means your trade system, your trade setup is invalidated. Say you want to go long off of a support. Well, that support needs to hold and your trade needs to go in the direction that you're heading. And so if that support is invalidated, whatever metric you are using to have that support be invalidated, whether it's a level or an EMA or some other kind of identified support system, hopefully, more than one as a confluence. If that fails, you need to be out. That means that your trade is not working. Your trade is invalidated. And so that stop out your stop placement should be purposeful, is what I'm trying to say. And so if your stop is placed at a purposeful place, what kind of leverage can you use to honor that? And it needs to be sometimes trading smaller with these smaller accounts, or as you're building up your cushion so that the account can live. And so that could mean that your max risk is 300 and ideally you'll make like 700 on that trade. If it works out in your direction, you can hold it to full target. So that's how you need to factor in position size based on where your stop has to be for the trade to be valid, if that makes sense. Now, another way people can look at this so it's not dollar rated is the multiple R tracking. So you can think about risk units. How many contracts are you using instead of like, I'm just going to risk, $700 or whatever, what have you. Sometimes it's easier to take the dollar amount off and just think about contracts, such as 3 micros will be less triggering than $400 when you think about it. Think about what works with your psychology in terms of referring to your stop position placement in dollar amounts or risk units, such as by saying contract sizes. That can normalize your performance across different position sizes and instruments. It can make it, a little bit of a gentler psychology to talk about contracts versus dollars. So this part is me. So your edge needs to fit your style. Essentially, I don't think that there is a one size fits all in trading. I just don't. I think that we're all different people. We all bring different backgrounds to trading. We all bring different psychology. We all bring different styles, different trade setups that speak to us. Some people are really good at trend trading. Some people are more contrarian with mean reversions, and then they have to work to improve in the other market condition. But in general, humans see certain things more easily than other humans just based on our brains and what we're bringing to the table when we become traders. So I wouldn't say that there's a hard and fast rule that you have to do, but the biggest deal for me is that you honor it. Is everyone still listening? Who's awake? Is everyone still awake? You guys didn't start Tequila Tuesday, did you? Without me? The biggest rule of stop loss management is that you honor it. Find a system. Okay. Find a system that works for you and then honor it. So it needs to be consistent, predefined, and within your account's risk tolerance. Those are the things. Yeah, showing up. Thanks, guys. So I did outline, I was thinking about what Matt was saying and what I've heard other traders do, and I know what I do, and I'll tell you what I do. But these are, if you look out there in the World Wide Web, there's these 5 different stop loss management systems. And I think a couple of these are what we use. So a fixed point stop loss, this is the opposite of gold standard. This is what a lot of people think you should do, but what no one who is actually a real trader thinks you should do. But it's a system. So this is a set number of points or ticks from your entry regardless of structure. Simple, consistent, easy to size around, best to think about, good for scalps, high frequency, predefined setups. Aw, thanks, Ricky. I love that. Getting some fresh air while you're doing it. Aw, thanks, guys. I appreciate you having me in your ear. Okay, so fixed point stop loss. Don't do it, but this is the system. Basically saying I have only ever take 5 points on ES. The end. I will only ever risk $250. That's that. It works because it's defined and it's logical and you don't have to overthink it. It can be a starting point, but I'll get into why it's not the GRESS system. But it's basically what I said on the other side is that your stop loss should be where the trade is invalidated. This kind of is like uncorrelated to that. If you think about it, it's just a 5 point stop. So it could be, your stop loss based on the trade setup is 6 points. And so a 5 point stop is within the area of liquidity that is highly likely to get wicked out just in normal variance movement. Now, ATR multiplier is great. That is the average true range. It's you're adjusting a stop based on the current volatility of the market that you are trading. So it's wider in more volatile situations and more volatile sessions, and then it's tighter in ranging conditions when the candles are not as large. So it's dynamic and it's market aware. So this is really great for swing trades because it gives you, more of a cushion and it's unique to that instrument. So if you're a swing trader, if you're a futures trader, no matter what you're trading, you need to always make sure your stop is unique to that instrument, that specific chart. $1 on a Tesla versus $1 on an AT&T stock is a very different conversation. Same thing with futures, like gold and NASDAQ, the Dow, they have different metrics. They have different point systems. And so ATR is beautiful because it is literally specific to the instrument that you have and the time frame that you have pulled up. So if you're trading intraday, maybe the 5 minute or the 3 minute chart, it will tell you how many points are within the range of how the candles are printing, what the volatility is. If we're having wide range, a lot of movement, big action, those trades will often require a little bit of a higher risk range in order to not get wicked out, essentially. So you can consider what your ATR is. It's a indicator on your chart. On all of the charting systems have it. And so look at that and start to think about what your ATR is for your range. And that is what you can base your stop based on in the conditions that you are trading. That way on your entry candle, you can put it outside the ATR. Say the ATR is 8. You can put it, decide whether you want it at 9 or 10 to give a little bit of wiggle room based on your instrument, if it's a percentage or a number of points outside the ATR. That way it won't get wicked out necessarily. If the trade is progressing in your direction, that will give you room within the volatility, if that makes sense. And more on ATR, absolutely rewatch Matt's technical lab from last week because he killed it. So I'm not going to spend too much time on it because he did such a great job. I really loved it. So swing structure stop. So that one is about levels, right? The stop is behind the most recent swing pivot point that invalidates your thesis. So respecting the market structure, this is a gold standard stop loss management system for technically based entries. Say the market pushed up to VWAP and it gave me an evening star and appeared to be following back down after that. So for me, this is how I will do it, is my swing structure stop. Most often I will factor in volatility with the ATR, but I need a pivot for my trades almost always, whether it's a pullback in a trending setup or whether it's a rejection in a range bound situation. I need a key level to show me a pivot. And then I will put my stop on the other side of that swing structure move. And so it's basically whatever structure movement will invalidate your thesis. If I'm seeing an evening star at VWAP for potential next leg down, if that is taken out with a bullish move, that pivot is broken for me. So then I need to be out. And so that respects market structure. And it's a very technically based strategy. Yeah, me too. That's mine too. And so I like, you have to factor in volatility, which is ATR. And so then that can give you your wiggle room on how much beyond the pivot you use. I think those two can be used in confluence, which is important as well. So you can put it right on top of the pivot, a tick above, or you can do a full point above based on the way it's kind of wicking sometimes. Now, indicator-based stop is super similar, but that's basically if price closes beyond a certain metric, such as a VWAP or a key EMA, such as a 9 or 15 EMA, or a market profile level, such as a value area high or value area low. If that level is invalidated, that indicator is invalidated, then your trade is off. So you've heard Coach Matt, not to say that he does this, but I've heard him say that he will have his stop trailing behind the 9 EMA in a trending move, which is a great opportunity because that's like a dynamic, directional indicator that's showing the direction of the movement, and that you can hold a trade a lot longer by using this strategy. So that one I like for potentially managing your risk in terms of snugging it up as the trade progresses. And so if you're trying to catch a trend and you're trying to catch a move that could happen all day long and you have at least one runner, this can be a metric for managing your stop loss movement throughout the day. You can trail it up based on a moving band, such as an EMA. Yeah. And then the last one is a time-based stop, which is sort of an outlier, but it was worth mentioning. So exit if the trade thesis has not played out within a defined time window. Basically, it prevents your capital from being tied up in a dead trade and reduces just wasting your time thinking about an open trade. If you really want, a trending move to happen and it's just sideways to the death of you, with prop funding companies, you can't hold trade overnight, but it could be that you only have 2 hours and then you have to go to your own doctor's appointment or what have you. You have to leave. If the trade hasn't moved and it's not to either place, that's when you might want to just cut it or snug things up because you're out of time. So that one's not very exciting. Ooh, I'm starting to talk fast. I'm running out of time. But basically that one was the money shot for me on the different types of stop loss management, and what I prefer, which is the structured pivot, is my jam. Now, this one is a sizing position, which I think is really critical. I'm just going to push through. I might go a few minutes over if that's okay, but get it, runners. So most traders will choose their contract size based on feel or their account size, or I want to trade 1 mini or whatever, how confident they are about a setup. But a professional approach, I think, is it's more mechanical, and it doesn't allow you to have basically, loose gray areas with this. It removes your emotional decisions with it. And so position size is derived from your stop distance, never the other way around. So I mentioned this earlier and I said I would come back to it. That's this conversation. Basically, if you use one of the above previous mentioned stop systems, whether it is ATR or a pivot point or some combination thereof, if you determine that on ES, for example, you need to have a 10-point stop loss, how much can you trade? Basically, what can your leverage be to have that trade be within your risk parameters for your accounts, for your trade system? If you only want to risk $400 and you need a 10-point stop, what can you trade? Can you trade one mini? Can you trade, 8 micros and scale out in 4 and 4? You want to be able to be very cognizant of how many contracts you're putting on and if your account or your system can hold that trade. I like having my max daily losses set on my accounts because it is a protector of my psychology. It really does stop the tilt. And so if I know I only have a $600 max daily loss on my accounts, I would like for that not to be triggered in one trade. And I would like for it to not be even, more than 50%, because then I really don't have another trade opportunity. So I want to make sure I'm trading the size of leverage that gives me room to trade in my day. And it doesn't mean that, let's say I put on a trade and it requires $800 risk because some kind of way I got in for 2 minis and then the risk of the trade is $800. Well, that's going to blow my daily loss for that day. So I don't want to do that. If I'm on minis, then I can only do one, or I can scale down and do a number of micros instead. So the main key there is honor the stop placement per your system and then figure out the leverage size that you can trade for that trade. Increasing your stop distance to give it more room without reducing the contract size is one of the most common and destructive risk management errors. It means that, you want to give it a little bit more room and you don't think about how much size you have on. Well, then maybe initially it would hold the trade and then it wouldn't hold the trade because you gave it that room and you had already sized in. That's where you get into trouble, where you can get into tilt. You can not realize what an outsized risk you actually got into once you add your full size in and then you start to adjust your stop. You're going to get in a situation. So you always want to pay attention to the amount of leverage you're having and stop yourself. Do not allow yourself to get in too heavy if your account can't hold it. So that's why leverage really has to be a conversation when you're talking about risk management, because it needs to be a fact. Basically, your strategy that you respect is the strategy that works for you. Okay, so it doesn't matter whether you use a 10-point fixed stop or a 1.5 times ATR structure stop. What matters is that you select the approach and you understand it. You ask around it. You drill into your mentor about it. You really feel like it works for your instrument and you've back tested it. It has a high success rate. This is the most reliable stop placement. Define it, which means write it down in a trade plan. Physically write it down. Put it in your trade plan what your stop management system is. Back test it. That way it is more robust and you understand it thoroughly. And then execute it without deviation. So the moment you start mixing methodologies mid-session, you give it more room, you flux with it, especially when you're under pressure, as in when you're in a trade, then you're abandoning your system and your rules and you're trading on impulse, which is not as reliable and can get you into trouble faster and can get you to pushing your thresholds in terms of blowing accounts and hitting max daily loss. That's where accounts go to die. You know what I'm saying? So this is a big deal. The whole stop loss conversation, define it, write it down, don't make it ambiguous, test it. That way you understand it and you see and you understand. I think you'll put more, for me, when I back test a strategy or any part of my trading, I have more faith in it and I will honor it more so because I have seen it play out in 100 back testing sessions and I believe in it. And so by testing it, that is basically putting your whole energy behind it because you believe that is a strong business model. Having done that, you should trust it. When your stop is hit, trust the plan. That was your plan. That was your energy going into it. It's performing as it is designed. So that is your back end of your system holding you down, protecting your capital. Like it's a protective stop because it protects you. Yeah, I love that, Omar, about trading 10 micros because then you can scale without risking your full retracement stop, which I absolutely love. When I trade micros, I will go in with 4 and 4, and then I will scale out half at 4, and then the other half is 4. And if I really love it, then I'll add the other 2 just because I don't know, it makes me happy to have the full 10. And then I'll scale out 4, 4 and hold 2 for my runner. If I really think that I've got a great trade, I can push the 4 where I scale, and then 2 is my runner to the end of time, ideally, right? And so honoring your stop is the last piece of this puzzle, right? You don't want to override it. You don't want to make exceptions. You've got to be able to take the hits so that your accounts can stay solvent and your capital can remain day over day and you're not hemorrhaging fees. It's professional approach to trading is defining the system, understanding it, putting your energy behind it, believing in it, and then honoring it. That way your data can build up and shore up your system over time. All right, you guys. So let's wrap it all back up, bring it all back together on what we talked about today. Because this is a lot. I talked a lot, but I was happy to chime in on this whole conversation. So losses are a part of the plan, not a failure of a trader, right? It's a part of a well-designed system for success. It's not a mistake. You have to manage risk. And by managing risk, that means you're going to have to take the hit sometimes. That's the gig. It just is. Sometimes it sucks. Nobody in here is a failure. For real. Like nobody in here is a failure, even if you are having a losing streak. It means that there is some data that you can work with and that you are showing up to labs like this, to labs like Matt's on last Thursday, where he talked about risk management as well. Like we're doing the job. And so taking a hit is another piece of that. And in that same thread, right, your ego is a risk. Letting your ego have too much play is a risk for your trading business. So you got to try and separate your identity from individual trade outcomes, because holding that on you is going to create too much emotional pressure and it will cause you to monkey with your stops more often. You need to embrace your trading system, not your trading outcomes. And that will help you lean into the math and the logistics and fine tuning your system to make it stronger instead of feeling any kind of bad about it. Capital preservation has to be your edge. So staying in the game is how you can learn and refine and get better. And by not blowing too much money or too much credit card debt on reset fees, you want to try and have longevity in the game, which means trading smaller and drilling into having a strong risk management system that you honor. And then size based on your stop. So for the strategy part of it, 2 big things for me: size based on your stop. So define your stop distance based on your system, and then calculate the amount of contracts that you can execute for that. That single habit is like huge for saving your accounts, because you don't get in over your head. Yes, trade for fun. This is absolutely recorded and will be cross-posted on our YouTube channel by the end of the night tonight, Pacific time. So by tomorrow morning for East Coasters. Yeah, I'll get it up there. Thank you. And then the last thing is commit to it, you guys. Personalize your approach and then commit to it. So your methodology, it really can reflect your style and your edge, how you see the market, how you set up your trade ideas. Base it based on that. If you're a value area trader, if you're a view up trader, if you're an EMA trader, make your system speak to you. That way you understand it full-heartedly and you believe in trusting it. And then you'll honor it more often, I think. Same thing with all kinds of thing trading. There's a lot of ways to, what's the phrase? There's so many ways to skin something. I don't like that statement. But you don't want to change it mid-trade. So having something you define and you honor, then you execute it consistently. So I would encourage you guys to just build the most robust system that you can and then execute on it consistently and let the data speak to you and refine it over time. Traders who make it long-term have a consistent risk management system and that they honor it. That works for them in market conditions. They can trade through their drawdowns. They can trade through their stop losses, not because it's easy, but because they believe in their business. Thank you, Matt, for being here with me today. I hope I did some justice on Becky's style, which is the whole mind, body, spirit energy of it, I guess. But this is what works for me, like hearing what everyone else does and then thinking about how it fits with my trading setups and making my own, because then I believe it. And when my trade is wrong, I don't want to be in that trade because that trade is no longer in play. So if you guys, and I know Breezy and Matt have said this as well, if you're writing up your trading system and you have any questions, like send us screenshots, like DM us in the chats at BluSky. We are totally here to be your coaches in these labs and then after the labs too. But send us, if you are writing your stop management and your risk management in your trade plan and you haven't previously defined it, define it and then send it to any one of us coaches and we can chat with you about it, because having a strong risk management system is key to longevity in this game. It really, really is. That's why this was such a great question by Ace and why we all kind of dove into it to talk about risk management as traders, because we want you guys all to be doing this with us and 10 years down the line. there's so much potential in trading, so much opportunity in the market that I just love being a part of. So that's what I got for today. Thank you guys for being here with me. I love BluSky and all of you, and I'm happy to be here. So that was it for Psychology Tuesday. Any questions, any requests for other topics, seriously, throw them out. You can put it in the chat here or just in the normal Discord. You can request things of all of us coaches, things you want us to talk about or cover. Otherwise, we're going to keep doing Psychology on Tuesdays, Matt's Technical Lab, all the things on Thursdays. Our BluSky podcast streams live on Mondays. Thank you guys for being here with us at BluSky. And as always, reach out with anything. And otherwise, we'll see you all on the charts tomorrow. Thanks for hanging with me today. Bye, guys.